Yesterday, when we finished, we were examining the utility function. We talked about diminishing marginal utility. The margin is the very last thing. Mark, put it away. We're talking about risk aversion, which is what brought us to diminishing marginal utility. We looked at the loss and gain of $1,000. So how do we manage that risk? We buy insurance. We had evaluated some of your insurance rates. What happens is that insurance allows you to pool your risk. Some of you may have insurance through the same carrier that I do. The insurance company views me as very low risk. The insurance company views you young women as higher risk, and you young men as much higher risk. So, no, it's not sexist, it's based on accident statistics. Young men have more accidents than young women. Their accidents tend to occur at higher speed, thus causing more damage to their vehicles. So what happens is the insurance company is willing to insure you, higher risk individuals, because they also insure me. And they're fairly certain that they're not going to have to pay out on my policy at the same rate that they're going to pay out on a teenager's policy. Now they charge me a lower rate than they do you, but they have a much higher expectancy of paying out on you. We think about health insurance. Take an 80-year-old versus a 18-year-old. Who is more likely to incur medical expenses? By far the 80-year-old. Pharmaceutical costs alone are going to be far higher. Right? So they're willing to insure the olders because they can also insure the youngers. Men tend to have a lower health insurance premium cost than women. You make babies, ladies, and babies are expensive, and delivering the babies is expensive. Men also, in general, are less likely to visit the doctor. Okay, so homeowners insurance here. Homeowners insurance. 10,000 people bear 1/10,000th the risk of a home burning down. And so those 9,999 other people's premiums help pay for the reimbursement of the 10,000 person's home was burned down. Because the premiums that you pay in do not cover the cost of the total loss of your home. So you need those other people paying in to cover it.
So when something like the California wildfires happen, how screwed is the insurance?
So what happens is insurance companies try to remain nationally diversified. You'll very rarely find an insurance company that only insures in California because earthquakes, mudslides, wildfires. That would be a very dangerous pool to be in. You don't find insurance companies that only cover the Southeast. Hurricanes, tornadoes. You don't find them that only cover the Midwest. So they cover the whole country so that they can diversify the risk.
What about in like a small town where they have a picture?
So that insurance agent is representing a national insurance company. You don't start up a small business insurance company. You have to have a huge amount of assets.
Like in a really small town though, like if they only have one insurance like company they're representing, but that's like all the town. What if the whole town wildfires? That's just
So that would be a huge loss for, let's say, State Farm in that town, but they've got the whole rest of the country and all their other insureds to cover. They've got all the other countries, all the other homes across the country that didn't burn down. Okay, flood regions, tremendously expensive. All right, So there are two problems that exist in the insurance markets, and one is adverse selection. Adverse selection. Those people who are high risk benefit more from insurance, and they're most likely to purchase insurance. So in this instance, we're not gonna think about auto insurance since you're legally required to have it. Okay? Let's talk about healthcare, because the mandate is gone, where the government required you to have healthcare. Congress eliminated that mandate. That was a big part of Obamacare, and it was a necessary part if Obamacare was going to work, or the Affordable Care Act was going to work, because of adverse selection. It is the people who have chronic illnesses and high medical costs who most need health insurance, but who have the hardest time affording it. So what the Affordable Care Act did is it offered government subsidies to bring those premium costs down, and it offered insurers a promise against adverse selection. By requiring everybody to be insured, the agreement was, we're going to give you lots and lots and lots of healthy people in their 20s who hardly use health insurance in exchange for you going ahead and insuring these chronically ill people, the diabetics, the people who have been transplant patients, et cetera, et cetera. With the mandate gone, it is adverse selection that makes it unlikely that those kinds of policies will continue to be renewed, because the insurance companies need to protect themselves against adverse selection, or they'll go bankrupt. The other problem is moral hazard. There's a great movie called Fried Green Tomatoes.
Love that.
Okay? And there is a scene in that movie where a woman is driving into a parking lot. She's going to get to a parking spot, and some young little thing in a sports car comes down the row and right into that parking spot. And she just backs up her car and runs it right into that little sports car. Road rage at its best, right? But the line that she delivers in the movie, when the young woman is like, "What? I'm older and I have more insurance." That is a perfect example of moral hazard. When you are insured and you take risks, when you grow up and you're getting your own life insurance policy, which you'll need if you have a mortgage or children, or generally a spouse, you'll find out that if you go skydiving, you're going to be very hard-pressed to find life insurance, and if you do, the life insurance policy will have a clause that says, "We will not pay out if you die while skydiving." You guys ever seen the Walendas, the typewire? Guessing they don't have life insurance. Okay. Because insurance companies can't guard against adverse selection and moral hazard, they take the premium that probably would be necessary and they go and turn it up just a little bit. Okay? So what happens is, the people who are really low risk, who don't think they're going to need that insurance, say, "Meh, I can do without it." And so they further dilute the pool that helps guard insurance companies against those folks who are more likely to use the insurance. Practice time. We're going to go through these pretty quickly. You're going to tell me, is it adverse selection or moral hazard? Don't blurt. I'm going to give you think time, and then we're going to answer. Moral selection or adverse hazard? Moral hazard or adverse selection? Yeah, Joe's a jerk. Right? Moral hazard or adverse selection?
Adverse selection.
than the fact that Gertrude's dumb. Moral hazard or adverse selection? I mean, you may as well just walk down the street and find people and be like, here, have my
I
things.
feel like she's doing that because they named her Had to kiss you,
Right.
Look at us. We're so
Boom! You got this. All right, so how do we measure risk? It has to be done. If we're going to put a value on it, we have to be able to measure it. So we use standard deviation. Stats students in here? A few of you? I know I got Davis. All right. The higher the standard deviation, the greater the risk. So we seek diversification. We're going to insure a house built on a wooded mountainside in California. Mudslide, earthquake, and fire hazard. Well, let's find a house that's in the country in Connecticut, where they hardly ever get wildfires, earthquakes, or mudslides. And it's not on a riverbank, so it's not a flood risk. Let's diversify our pool. Okay? Some of those assets are going to get high returns, meaning they're going to pay in and pay in and pay in and never take out. And others are going to pay in their premiums and be hitting you for an insurance claim all the time. In the end, what you hope is that you find that kind of middle road. You want to insure more or fewer high-risk assets. You want fewer high-risk assets than you do safe ones, even though you're charging them a higher premium.
Wait, so is that how they make money?
Yes. Is off the low risk.
The insurance companies lose money in a year where there's mudfires, mudslides, and
That would be so
wildfires.
scary. I would literally be so terrified.
Oh my gosh, I could just slip
The
in above it,
floor
like,
is
oh.
lava.
Oh, wait.
That is California.
Fire
The floor is lava.
Fire, mud is really-
Okay.
Don't take pictures of me.
In a year where there's mudslides and wildfires and flooding in California, insurance companies that are overinsured in California might be taking a loss. Insurance companies in a year when there's all of that stuff in California and Texas gets hit by hurricane and flooding, and Florida gets hit by hurricane and flooding, and Puerto Rico gets hit by hurricane and flooding, some insurance companies may not be having such a great year.
Does insurance work on like a contract, or like how long does insurance last? Because like after a while, can they just like stop insuring a place?
If you put too many claims in, they can notify you that they're not going to renew your policy. It's generally annual.
So every
That way,
year.
if you get in a car accident, a lot of times you get
Yeah. They will definitely notify you that they're going to raise your premiums.
Wait,
And if you keep filing claims, at some point they'll say, yeah, you're not worth it anymore. And then you get put into what's known as a high risk pool, and your premiums would be really expensive.
So does crop insurance work that?
Crop insurance works the same way, yes.
what about like medical insurance? Like, is it renewed every year? Because like, what if I got like cancer one year and then
No, medical insurance, once you've got the policy, you're good. But one of the things pre-Affordable Care Act is insurance policies would have a lifetime limit. For instance, I remember my grandmother had a stroke when I was 5 and lived almost 13 years in skilled care nursing. And we would watch, because I would always help file the claims and all that kind of stuff, and we would watch her inch ever closer to that lifetime limit. At that point, I think it was maybe $500,000 that the insurance company would pay out for her care. And she died at about $495,000.
so like at a certain point they just stop paying?
Yep.
But what about lifetime? I don't know.
Well, the Affordable Care Act said no more lifetime limits. And they said you can't be dropped for a condition. And one of the biggest things the Affordable Care Act did is they said you cannot be denied for a pre-existing condition.
So like if I had diabetes or something something they can't deny me insurance.
Because what happens is most people get insurance through their employers. And so if I left Buckley Vista schools and I had cancer, okay, and I go and I'm gonna be employed by OPS, what the pre-existing condition thing did is it said, we're not gonna cover pre-existing conditions, period. So a recurrence of my cancer, continued treatment, so people would be trapped in their job. And so let's say my husband was a military officer and got transferred. Right? Now, the military insurance is still gonna cover me, but a lot of people, when they have two spouses, will carry both insurance so that they pay virtually nothing.
What about,
Or,
is it dropped? So now
or
they
I
can-
have a kid who has a condition. Let's say I have a child born with spina bifida. Okay? High medical costs. Bad news. The other thing that they've done is they've limited the window. So now they can't deny you coverage on the basis of pre-existing condition, but they can say, we gotta wait a year before we'll cover anything related to that. That's better.
I mean, it's,
That's better. The other real gift to you guys is you're covered under your parents' insurance until you're 25.
How did you know she's talking about
You're covered until you're 25.
I'm
Though,
worried
if they
about that.
succeed in fully repealing the Affordable Care Act, you'll be in the same boat I was in. I went to grad school, and I turned 21
Does that cut the
while I was in grad school. And so I, on my $650 a month grad assistantship salary, was paying $250 a month for my health insurance.
are you kidding me?
So
Is
when
it
my
cheaper
car
to be on
died,
your
that's why my
parents?
sister had to co-sign a loan.
If you're on your parents, is it cheaper?
Your parents are
covered.
paying for you.
Yeah.
Wait, so does
You're on
that,
your parents' plan, but they're still paying for you.
But what if your parents, what if your parents were like, you can stay on ours because it's cheaper, but you'll pay us? Like, is it cheaper to be on your parents' plan or
So-
go individual?
So when your parents are paying for their insurance, it's probably a deduction from their paycheck. And here's how it works. You happen to have a family of 5. So you get an individual premium price, you get a family premium price. Doesn't matter whether you have 1 kid or 8. So once they're married and have the family, so yeah.
I know, like, for, cause my dad was in the military, cause we have
Right here.
striker, as long as I'm in school, they'll like, cause he took, when he retired, he took the salary less and the insurance more, or as long as I'm enrolled in any kind of schooling, I get it till I turn 25, like, no matter what.
Yeah, whether Affordable Care goes away or
What-
not.
yeah,
So are they
I'm
trying to get rid of it to make our, like, what's the benefit for them?
Benefit for them who,
Like, for the
insurance
government,
companies make
the
more money.
insurance companies make more money, so they're pro, like,
No, the
Mhm.
government, it's just a fight because the Republicans don't want government
Yeah,
standards.
it's government control. The government is regulating insurance and
Yeah, that's what they
requiring
don't want.
insurance companies to do these things, and that opposes the free market.
They don't like that the government has their fingers dipped in the whole market, that's the only reason.
well, because then it
It's
doesn't.
not necessarily the only reason that they're fighting, but it's the most significant reason.
Yeah.
Well, and then once they get involved, they can't make as much money because they aren't in control.
Correct. Though they find other ways to. Another one, I was talking with somebody, who was I talking to about retirement age? I was talking with somebody in here about retirement age, and it said, my dad was able to retire at 65, though hardly anybody actually retires, goes and lives in cabin in the woods. I can't retire until I'm 67 and a half. They changed the Social Security full payout. You can still retire before that, but the amount you get monthly will be decreased. So if I want my full payout, I'll work until I'm 67 and a half. If I want the increased payout, I'll work until I'm 70. If I have enough saved, I could go at 65. So somebody was saying, well, what if I've saved a lot more than that? What if I want to retire at 50? Fantastic. Elon Musk could retire tomorrow. In fact, he's already retired once. But here's the thing. You retire, you gotta pay for your own health insurance. And that is what keeps a lot of people working. Medicare, Medicaid and Medicare. Medicaid, aid, is for the poor. Medicare ends in E for elderly. Okay? You don't get Medicare until you're 65. So by the rule of 85, which is what covers teaching retirement, I'll be able to retire at 58. But you can bet I won't, because I won't have enough money to retire and pay 7 years of my own health insurance premiums. And I'm in a high-risk pool because both of my parents have had cancer and both have had heart attacks. Or both had heart attacks, so yeah. So paying my own insurance at the age of 58 won't be swell. So I'll be teaching probably until I'm 70. Or doing
Let's
something.
be honest, you'd be broadcasting to you're like 105.
Yeah, nobody wants to see that. All right. So, diversification can reduce the firm-specific risk, meaning that in one insurance company diversifies and they reduce their risk. Okay? It can't reduce market risk, which is the risk across all insurance companies. Yes?
What do you think the odds are that Social Security will still be around when we get
Less.
Ever decreasing.
Isn't it just like an
But I hope you all get well educated and or have high paying jobs so that you can continue to pay in so that I can retire.
I hope I have a high paid job.
I'm very much counting on you having a high paying job.
Lauren,
I'm scared to graduate college and literally still on.
Alright.
Lauren, sugar daddy doesn't count as high paid job.
Oh, yes, it
No, you just have to make it.
So when we think about investing, if you have $10,000 and you buy one stock, are you diversified?
No.
If you buy two stocks, are you diversified?
No.
3,
No.
4,
No.
5?
No.
Well, what if I'm gonna buy 5 different companies. I'm gonna buy Hilton, I'm gonna buy Marriott, I'm gonna buy Holiday Inn.
Go with Marriott.
All in the same.
All in hotels.
So if we have another 9/11 and planes are grounded and travel stops,
You're screwed.
okay? All right. So I'm gonna buy American Airlines and Marriott and Hertz
No.
and
Delta,
These are all traveling.
okay. All right.
Snapchat,
What if I buy
Facebook.
Google
Okay.
and ExxonMobil and Bayer Pharmaceutical?
Okay.
How am I doing so far?
Pretty good.
General Motors,
Okay.
Procter & Gamble.
Perfect.
All right. I have at least covered different areas of the market, right? I still would say 5 isn't real diversified. Those are 5 pretty big firms. Probably want to get into some emerging markets, might want to invest outside the country. The more diversified you are, larger number of stocks, the lower your risk. Follow? All right. You cannot eliminate all the risk. Can't be done. If I were investing right now, looking at the population of our country and the aging baby boomers, I would be putting some money into firms that specialize in long-term care, elder care, dementia care, memory care. I would be investing in firms that are researching pharmaceuticals to deal with Alzheimer's, osteoporosis, those kinds of things. Little chin, yes, business is about to be booming. Because, guys, just like we will rent a storage space for our stuff that we're not currently using, right? That market has blown up a lot, right? How many of your families have a storage unit somewhere with stuff in it? Yeah. So think about this. It sounds pretty callous, but in reality it's sort of true. Retirement homes, assisted living places, nursing homes are well-staffed storage facilities for our elderly.
Damn.
How many of you went to daycare when you were young? Parents worked and you went to daycare. You were also in a storage facility for our youth.
This is so good.
You began and end your life in a storage facility.
I love it.
I'm gonna die before I go to one.
You also will begin and end your life in
Those are
diapers.
No way. I'm gonna be free ball.
All right. Now, there are trade-offs. If you are less risk averse, you are willing to assume more risk, you can expect a higher payout. If you more greatly diversify and reduce your risk, you can expect a lower payout. Okay? So, over 200 years, if you were in the stock market, you'd have gotten on average 8%. Whereas if you were in short-term government bonds, 3%. Here's the difference. At any given time, you were pretty darn sure you were going to get that 3%. We have had some definite periods in the last 200 years where that was a negative number, and if you needed your money, you weren't getting it. Got this? You've got a fairly diversified group, but they're still risky stocks. They're startup companies, tech companies. Okay? And then you buy some municipal bonds. Zero risk. Alright? You're putting your portfolio between those two assets. How much you get depends upon how you diversify it. If you go 50-50, you're going to get 2.5%. You're going to get 5.5% gain, right? Theoretically. The older you get, the more you should be here, and the less you should be here. At your age or when you first start investing, you should be much more here and very little here. You want that growth early. So we can look at this trade-off as the standard deviation gets higher versus the percent of return. Really clear, isn't it? Really straightforward, common sense.
How do you have 3% return if there's no stock?
Because you're holding bonds or CDs. By the way, I saw an ad in yesterday's paper, an 8-month CD paying 1.25%. For right now, yeah. Remember, most people's savings accounts are earning less than 1%. All right. So, to decide whether or not to buy the stock, you look at the price of the share compared to the value of the company. The share price is more than the value. Say that they have 1,000 shares outstanding, okay, and each share is costing $100. What should the value of the company be at the very least? 10,001. If the outstanding share value is $10,000 and the company is valued at $5,000, don't buy that stock. Short that stock, because that company isn't going to last. Okay? If the price is under the value of the company, and it's not just the price versus the value, it's the price times the number of shares outstanding. How many shares are they issued? And go ahead and buy it. There's room for growth here. If they're equivalent, safe bet. So this is where present value and future value come in. You buy a share of AT&T today, you're going to sell it in 3 years for $30. Every year along the way, you're going to get a dividend. That's your share of AT&T's profit of $1. So at the end of the 3 years, how much money are you going to have? $33.
Oh, what a
Rich.
Wow.
Rich.
Wow.
Okay. If the prevailing interest rate is 10%, what should that value of that one share of stock be today? It's going to be worth 33% in 3 years. Get your present value, future value equations out. Your R is 10%. Set it up like this. You gotta do it year by year. So what's the present value of the dollar that you get at the end of year 2? You're gonna receive $1 in year 2. What's its present value? Survey says the present value of the dollar you're going to receive in 2 years is $1.60. What's the present value of the dollar that you're going to get in the 3rd year? Which is what? You said 75 cents? Just guessing?
Yeah, it's 75 cents.
Bravo. How about that $30 we're going to get when we sell the share of stock in 3 years?
68 cents.
The $30 share of stock is worth 68 cents?
Yeah. No. $1 is 68 cents.
You're not going to get $1 in year 3. What is the value of the $30 share of stock? If you're going to sell it for $30 in 3 years, what's it worth today? It's the present value of $30 in 3 years. What'd you get? 22. What'd you get, Kevin?
I got 24. I got 22.
So, to determine whether or not you should buy that share of stock, you add up all of those numbers, and if they're equal to or less than the current price of the stock, buy it. Here's the difficulty. You will never know what the dividend payout is going to be because it depends upon the profit of the company, and the board of the company votes on how much to pay out in dividends. So you can't really forecast this, nor can you actually know what the value of the stock will be in 3 years, which is what makes the market such a mystery.
So you said if it adds up to less than it you invested?
Less than or equal to what it currently costs, buy it.
Is that because that's what it would cost? So basically that's the future money of what it would cost now? Okay. I was like, wouldn't you lose money there?
So if you could buy that share of AT&T stock for $20 today, do it. You're going to be ahead. If AT&T is trading at $28 today, you will have lost value. Follow? All right. The asset valuation is the present value of the dividends plus the present value of the price you're going to get, which is what you just calculated. You calculated the present value of the dividends and the present value of the share price in the future. Both numbers which it will be impossible for you to obtain in anything other than an imaginary scenario. Good companies will issue forecasts. They'll issue earnings and outlooks. What do you suppose they will always do to those? They will shine them up something fierce. Have you ever heard of the phrase putting lipstick on a pig? Yeah, purdy it up. No matter how ugly it is, purdy it up. Make it look as good as you can. I always think I ought to insert a sad trombone sound effect for when I put that up. Wah, wah. So I've just taught you to do something that you'll never actually be able to do. And you can be pretty sure that anything that the company puts out, any numbers that they put out forecasting what those future dividends and future stock values will always exceed the present value of the stock. So then you go to what's called the fundamental analysis. A publicly traded company is required to publish certain information about itself. And you go and you make sure by evaluating those numbers. This is what stock analysts and investment advisors do. They look at the fundamentals. You ever heard that? Turn on CNBC sometime and some guy will be on there and they say, well, Chuck, although their earnings are a little less than expected in the past quarter, the fundamentals are sound. What they're saying is they have some money, they have some cash assets, they don't have too much debt, they've been growing, they're in the right places and in the right markets, they're not hurting for the right skilled employees, fundamentals are sound. I think this is a solid buy. You can believe that as long as the information that the company has released is accurate. And places like the SEC, the Securities and Exchange Commission, are going to be on a company if they knowingly falsify any of those fundamentals that they publish. But is it possible for a company to employ someone who is less than ethical? Someone who might be embezzling, or for a company to not know about an internal problem? Or for a company to not know about a liability? There could be a pharmaceutical on the market right now that we don't know about, an unknown side effect. It was just released 2 years ago, lots and lots and lots of people are taking it, and we'll find out at year 5 after its release that it causes massive malignant brain tumors. Well, no matter how good the fundamentals of that insurance company were, that's going to be a really ugly quarter when that information comes out and it's attributed to that pharmaceutical. Right? So no matter how much analysis you do, no matter how much information you obtain, your crystal ball can't show it all. All right. You have an account with Merrill Lynch. Broker calls you. Hey, I got this great stock. You gotta get in. Just give me $1,000. I'll get you 100 shares. It's gonna be awesome. I'll make you rich overnight. First of all, if it sounds too good to be true,
Probably is.
don't be suckers. Should you buy that stock?
No.
Who said yes?
I did.
All right, David. Why?
I'm kidding.
Oh.
Waffle.
The answer is, the correct answer is,
Maybe.
I don't know yet. What you got to say to that broker is, hey man, can you send me? What you want to ask for is, it's a document called the prospectus. It's a fancy word, means tell me about the prospects of the company. Now that's published by the company, so it's going to be pretty rosy. You want to say, what's your fundamental analysis on the company? Chances are, if he's just a broker, he hasn't done any, he's just gotten somebody else's fundamental analysis. You should still ask for it, and you should read it and think about it. Don't just take somebody else's word for it. I heard a guy behind me in the grocery store talking on the phone to his broker, and yeah, not a good plan.
What was his plan?
I was,
Wait, was that a joke?
yes.
Oh.
220.
All right.
You said at the grocery store, that sounds reasonable.
So the efficient market hypothesis tells us
What'd you say to me?
Oh.
that the asset price, the value of the share of the stock, should reflect all of the publicly available information. Here's the thing, folks. Not all information about a stock is required to be made public. Companies are allowed to keep secrets. Yes. Secrets.
I don't like that.
For instance, a pharmaceutical company has multiple drugs in testing at one time. And they may have published a prospectus last year because the first trials were looking really good. The animal trials were looking really good, and they published a prospectus and said this drug is expected to begin FDA testing, and it's released in 2 years, and you're reading that, and you're like, yes! And then this year they started the first clinical testing, and it's not good. It's not good. Bad, 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 bad. People are going blind in their left eye.
Just
Just their left eye. Yeah, it's weird, especially because it's a cream for sores on your rumpus. So why it's causing blindness in the left eye, I don't know. Maybe people put it on with their left hand and then rumpus, whatever. But they don't have to release that information the minute they find it out. They don't have to put it out there until the next filing date.
Are you serious?
So, all publicly available information. There are secrets. Aiden, am I interrupting something?
No.
All right. We assume that the stock market is informationally efficient. If the information is out there, it's going to get disseminated pretty quickly. Anybody who shows you a chart of the stock prices and says, because it did this back here and it did this there, then I know that in the future it's going to... You look at them and you say, bull, I know about the random walk. You're just making stuff up. You cannot accurately predict the movement of stock prices. Because guess what is a huge dynamic in the stock market? People! And people have free will. And as much as you want to think about your fellow man as sheeple, there are still people who think and act independently. And even the motion of a herd cannot always be predicted. We've all seen The Lion King, right? Stampedes aren't predictable. And a run on the market is nothing but a stampede with money. You cannot beat the market. And anybody who tries to sell you a book, sell you a ticket to a 3-day conference where they can give you this great investment strategy to beat the market, that's their method for beating the market. They're finding a bunch of suckers to come and sit in a room and listen to them tell them about some made-up plan to beat the market. That's how they're making their money. All right. Index fund is a managed fund, or it's a mutual fund that just buys all the stocks in a stock index. So you can buy the hospitality index, which is going to be restaurants and hotels. You can buy the travel index, which is going to include airlines, rentals agencies, and hotels. Okay? You can buy the transportation, which is going to be trucking companies, railroads, airline shipping companies. You can buy the fossil fuel. Okay? You can buy pharmaceuticals. What are you laughing at?
I'm not laughing.
Okay. You can buy all of these different things, or you can buy something that buys all of the stocks in the entire market, like a spider fund. It buys everything in the NASDAQ. Okay? You can buy a Dow fund, which is just going to be the Dow 30 Industrial. An actively managed mutual fund, somebody's sitting there watching all of the stocks that they own every day, reading all of the fundamental analysis, reading all the prospectuses, and saying, uh-oh, this company is headed for a downturn, and they decide to sell those shares of stock in the fund and invest in another company in the fund. There are fees associated with managed mutual funds. And the more managed they are, the higher the fee, the less you make when the mutual fund makes money. And guess what? If the mutual fund loses money, that fund manager still expects to be paid. Doesn't get paid less because this fund lost money. So choose your mutual fund well and only after solid research. Because we know about the efficient market hypothesis, we know that the returns on an actively managed fund shouldn't really exceed what the average going rate of growth is. In fact, quite historically, index funds exceed managed funds. because of the expenses. Well, and so you take the expenses out and they way exceed, not because of, right? Seems pretty obvious, huh? We had a housing bubble in the 90s that burst. It's when you first started seeing flipping of houses as they were going down in value. And then lots of people thought, oh, I can flip a house, it's easy. They do it on TV. And so more people were buying those up and were being irrationally exuberant. It takes a lot of work to maintain a house, let alone flip one. And if all you own is the standard set of screwdrivers from Craftsman, flipping a house might be slightly beyond your skill set. Just a touch. And only half of those screwdrivers will work on any given screw. It's not fair. So in the end, you can make some educated guesses. You can read all the information. Nothing is ever a sure thing. Don't ever take somebody else's word for it. And even when you've done the analysis, doubt yourself. Be careful. Know how much you can afford to lose, and don't put more than that on the table. Whether it's a game of chance or the stock market. Go back.
Yeah, just one.
So what's insider trading?
Insider trading is when I work for the company and I know some of that secret information that hasn't been made public yet, and I make trades based upon my possession of that knowledge.